Hello, everyone. Today we are here with Derek Nichols. The reason that I invite him is it will be great to share with us what options are in the market to reduce the interest rate. So, number one, Derek, for how long have you been in real estate?
I've been in lending since 2002. So I survived the Great Recession of 2008, 2009. I was in lending that entire time. Since then, I started my own company, Alpha Capital Group, and we're doing great. But yeah, talking about how can a buyer get a better interest rate. So we do know that rates have already started to trickle down as we head into 2024, which is good. And the forecast is basically that the Fed's not going to increase rates anymore. We're looking to have a trending downward slope of interest rates as we go through 2024. I don't think it's going to be dramatically. I don't think there's going to be any dramatic drops. But I think if right now we're like at the low 6%, I think by the end of 2024 we should be in the low 5%. Is basically what's being forecasted. Hopefully it's lower than that, but that's what they forecasted. So what do we do for a client who's trying to buy a home now? How do they take advantage of getting an even lower interest rate, lower than currently, let's say 6.25%? There's a few ways to do that, but one of the best tools that we have at our disposal that we never had before is this buy down program. And let me just kind of explain that a little bit. What the buy down program is basically a bubble. It's a shelter for the buyer to shelter them against the current market conditions. So what's happening is paid for by the seller. So what's happening is buyer gets pre-approved with their bank. Let's say the bank's offering them a 6.25% interest rate, 6.25 on a 30-year fixed. With a buy down program, that's something that the seller would actually pay, part of the negotiation between the buyer's agent and the listing agent. The seller would offer to pay for this buy down program for the buyer to incentivize the buyer to move forward on this purchase. In doing so, let's say that they got what's called a 2-1 buy down, which is kind of the basic buy down program that's offered right now. What that means is that the seller is going to grant them or gift them or credit them, the amount of money is needed for this buy down. Now that could be $5,000, it could be $10,000, it could be $15,000. It's all based on the loan amount that's being financed by the buyer. But what it does again is if the bank's offering them 6.25% and the seller agrees to help with the 2-1 buy down program, that borrower isn't going to feel the payment of 6.25%. They're going to feel the payment of 4.25% for the first year, of 5.25% the second year, and by the third year, when all of the seller credit depletes and there's nothing more, then they'd return back to their scheduled payment based on a 6.25% rate. And the reason I say that's a bubble is because what we're doing is we're using the seller's credit to lower their payments for the first 2 years, so that when they can go to refinance on year 3, when their payment finally reverts back to what they originally agreed to, which is 6.25% rate, they can refinance and to current market conditions. And the hope is that in the next 24 months, if they are looking to pay a 4.25% rate, that'll actually be available for them on a 30-year fixed. So that's what the buy down program does. It immediately helps the buyer have a lesser obligation, a lesser payment for the first 2 years, and thereby sheltering them from the current market conditions. Even as we're trending downward, which is the way we want it to go, by the time that 24 months is up, we should be able to refinance that buyer so they never actually were impacted and never actually felt that 6.25% rate. There's variables to this. There's a 1-1 buy down, the 2-1 buy down, which I just talked about, and even a 3-1 buy down, which again is just meaning that the seller credit is going to offset the buyer's payment for 1 year if it's a 1-1, 2 years if it's a 2-1, or even 3 years if it's a 3-1. We never had this before. The best thing we had before was basically an ARM, which I'm sure everyone's familiar with, which is an adjustable rate mortgage. And that is completely different, because what that does is basically give you a slightly, and I mean slightly, maybe if you qualified for 6.25%, then maybe you got a rate with an ARM of 6%. So it would give you a slightly better rate, but it's a lot of times quoted as a teaser rate, because that rate may be fixed for, let's say, it's a 5-1 ARM, 7-1 ARM. It's only fixed for 5 years at that 6%, and then after that, it's going to adjust, and typically it would adjust up. So that would actually make your payment go up, and then it would basically force you to refinance. Whereas what the 2-1 buy down does, it locks you into a 30-year fixed. So you have a 30-year fixed at, let's say, the current market 6.25. It's never going to go higher than that ever. But the 2-1 buy down gives the seller credit to shelter that payment for the first 2 years. So although they're locked into a 30-year fixed loan and payment, they're only going to feel the impact of a 4.25 the first year, a 5.25 the second year, and by the third year, when they actually make, like they're actually due to make the regularly scheduled payment, the idea then would be to refinance that individual. So that way they're then again benefiting from where the current market is. This has been a fantastic tool. It's helped save customers hundreds of dollars a month. I had a client close an escrow a month ago that was saving $1,006 a month just based on this 2-1 buy down. So it's much more impactful than an ARM. And if you tried to compare it to a bona fide discount point, bona fide discount point is where the buyer pays a point. So in other words, a 1% of what their finance loan amount is. They're paying 1 point, but it doesn't offset to 1% in the interest rate given. So for example, if they qualified for 6.25 on the interest rate and they wanted to pay bona fide discount points to buy down that rate through the bank, let's say they paid 1%. So let's say they were buying a house and they financed $500,000. 1% would be $5,000. They would pay that, and it might buy down their rate from 6.25 to, again, maybe only 6%. So it's not as impactful.
It's a big difference.
It's a big difference. It's not as impactful. You're paying $5,000 right now, ready money, and you're feeling a difference in your monthly obligation with maybe $100, or not that much monthly. Now, if it's projected over 30 years and they never refinance, fantastic. Yes, you're paying $5,000, and over the life of the loan, you'll probably save $25,000. But that's if you kept the loan for 30 years. And nobody in Southern California does that. Everyone refinances or sells or whatever. So to really get the best bang for your buck, I would say definitely investigate and research and ask questions about the buy down programs. Alpha Capital is available. Monica Dallas is available for those questions, obviously. But that would be something that would really impact first-time home buyers or just buyers in general. Because again, it's not something that we had back in the recession days of 2008. It's not something we had in the early 2000s. All we talked about then was just ARMs. And this is not that. This is actually something that was created to offset what the Fed's doing or what the Fed did this year in 2023. To offset inflation, they had to start raising rates. And this is trying to protect buyers so that the housing market can continue and people don't have to pay these exorbitant interest rates while the government corrects the inflationary rate and brings back everything back down. So yeah, I mean, happy to discuss this further. You can reach out to me, Derek, at alphalg.com. But yeah, Monica, what else can we talk about?
So I think one important question is, people always ask me, hey, how long do I need to wait if I can refi? Because right now the interests are high.
Right.
So everybody thinks that the interests are going to go down. Can you please help us to give some perspective on this?
So the general rule of thumb is, number one, making sure that you don't have a prepayment penalty. Typically, if you have a regular FHA loan, a regular VA loan, a loan that's Fannie or Freddie compliant, like a regular conventional loan, more than likely you're not going to have a prepayment penalty. So you can definitely investigate that first, because you never want to pay your loan off sooner than you're allowed to, because then you would have prepaid interest as a penalty, and that could be thousands of dollars. So I'd never want someone to do that. I'd always want them to first check, do I have a prepayment penalty in my loan? Assuming you don't, then typically the rule of thumb is you want to make sure that there's enough benefit in the monthly payment. So if you have a large loan amount, the benefit may, like of 0.5% or even 0.25%, may actually make sense for you monthly. If you're financing a $900,000 loan at 6.25, and you look at, okay, that's, for instance, this isn't right math, just to give you an example. If that payment was $9,000 a month, and you find that if you can lower your rate by 0.25% or 0.3%, and that's saving you $500, then it may make sense to move forward. But you always want to weigh that out, because every time you refinance, you're recasting your note for another 30 years, unless you do a 25-year or 20-year. But typically what people do is they start with a 30-year note, and then they wait for the rates to get a little bit better, and then they do a refinance, which is dramatically going to help them as far as monthly, because they're getting a better rate. But they have to also consider, is it recasting your note? Are you starting over on that 30-year timeline? or are you refinancing into like a 25-year note or a 20-year note? So that way you can keep with your original timeline, but still save money, or just pay less interest. Maybe a lot of times people lower their term. They're not necessarily saving money, but they are saving money in the end game because they're paying their note off sooner, and therefore they're cutting off all that interest at the end of the note that's due. But I would say it's a case-by-case basis when you're looking to refinance. As far as how quickly you can refinance, typically banks want you to keep the note for at least 6 payments. And there's a few reasons for that. So like, for example, you close an escrow, and you're okay with the payment. You're not totally thrilled. It's in the 6s. You want to refinance to the 5s. We're talking about this here at the end of 2023. Let's say, July 2024, rates are at 5.5%. You're like, okay, that's a solid percent lower. I want to refinance. I would totally agree with that. You've been with the bank. You've made 6 payments. That does a couple of things. One, there's typically not a prepayment penalty for 6 months, but sometimes banks have that. So even if there was that, you're away from that. But then also, when you have a new trade line, such as a mortgage, a new trade line on your credit report, it's awesome to pay that on time and have an established payment history. And 6 months is about the least amount of time to really establish a strong payment history. And that's only going to help your credit. So my rule of thumb, again, would be once you close on an escrow and you're looking to refinance, I would still wait about 6 payments, make all those payments on time, and then review where the current market is. And if you're at 6.25, 6.5 now, and you review everything in 6 months, and you're at 5.5 or 6%, in other words, about 0.5% lower, that's definitely something that you should look into. It may not be enough for you to ultimately move on, but you want to see like where the market is, and you want to see how much money you could potentially save. And then it's up to you. If you think that $400 a month savings is beneficial, then you would want to move forward on that. I know $50 is beneficial for me, so I want to make sure that I'm always got the best deal possible on my finances. But yeah, I would say the rule of thumb, the takeaway from this would be give it about 6 payments before you're looking to refi. Make sure there's no prepayment penalty, and then compare what the current market's offering versus what you have. If there's about a 0.5% interest rate, even that might be enough to really take advantage and refinance. That'd be my advice.
Thank you, Derek. And one thing that I have been talking with Derek is it amazes me how much, in a specific case, the interest rate can change. So each person is different, and I think that I will love for you to share a little bit of that, because I have seen cases that people that has wonderful credit, and their case is completely different of what we see in the market.
There's a lot of factors that go into qualifying someone for what rate they're going to get. That's why you want to speak to your banker, your broker, to kind of go over what exactly you fall into, because it's not just everybody gets this rate. The main criteria would be, I would say, number one is credit. How good is your credit score? What's your credit score? If you're looking to do a conventional loan using, Freddie or Fannie, Freddie Mac or Fannie Mae, typically they want to see higher scores north of 700, 720. That's where you really see the benefit of using a conventional loan. Okay. If you're beneath 720, then you're probably going to lean more on FHA. Again, you can get qualified with both, but I know that Fannie Mae and Freddie Mac, they grade a little bit harsher, and therefore the interest rate's higher once you're below that 720 mark. It's not to say you can't use their financing, it just becomes less advantageous for you. Versus FHA financing, the truth is, if the lenders that I use, if you have at least a 640 or higher, you're great with them. That's enough for them to give you a very, very good interest rate. The caveat to that is that the mortgage insurance premium with FHA is a bit more expensive than it is with conventional. So you have to weigh out both. So what I do with my clients a lot of the time is I will actually price up or work up, here's what you'd qualify for going conventional, and here's what you qualify for going FHA. So they can kind of see it themselves. So they can compare what the interest rate FHA is offering them, the rate that Fannie Mae, Freddie Mac is offering them, and the associated mortgage insurance that goes with that. So they get a full picture of, okay, here's exactly how it benefits us, and then they can choose which route they want to take. Because again, like Monica mentioned, every case is different. So you want to just know all your options. And that's more so, I think, why we're a team here is
Yes.
My job is to just explain. My job is to explain, work up all the options, and let the borrower, let the client kind of see for themselves. And a lot of times people are visual, so I can make illustrations and kind of show like here it is in black and white, the comparison, and make charts and tables. And some people are, auditory is good. You can just hear me and you're like, yep, I hear the payment. You told me the difference. We're good. But I think that's the biggest thing. And the takeaway from that is that what you see, if you like look online and you see like, oh, the market is this, the rate is this, a lot of times that's based on really good, really high credit scores. It's also based on how much money that individual is putting down. A lot of times those interest rates that you see quoted are assuming a 20% down payment. And that's, in my opinion, not realistic, because I don't believe that everyone's got 20% to put down, especially first-time home buyers. So realistically, when I look at that, I'm thinking, okay, that's a little bit skewed, those online advertisements, because that's, again, fitting this box that I think most people don't fit into. So when I'm looking at things, I'm looking at that exact scenario. Are they putting down 5%? Are they putting down 10? Are they putting down 15? Are they going FHA and only putting down 3.5% because that's the minimum obligation? All of that you factor, and all that has an impact to the interest rate. But generally speaking, if you are a first-time home buyer and you don't have a lot of money or assets to put down, and maybe your credit's not as strong because you haven't been in the market very long because you're a first-time home buyer, then maybe that's why we have, I would say, an FHA might be better fit for you, because they require less money down, because you can have a less strong of a score and still get a very good interest rate. And that may be your foot in the door as far as getting the home. And then later, as you make your payments on time and as you progress, then you'll refinance into a Fannie or Freddie product and basically get rid of the mortgage insurance that's tied with FHA. So that's a lot of times a two-step process for a first-time home buyer. If you're not a first-time home buyer and this is something not new to you, and this is just another house that you're buying as you progress in life, then you can look at conventional financing and kind of look at, okay, on this we're going to put down 30%, we're going to put down 10% or 5% or what have you. But you've already kind of established yourself, and therefore the thought process is that your FICO score is stronger, so you're not going to get graded as harshly with Fannie and Freddie, and that's why you go conventional.
Thank you, Derek. One of the things that have helped us when we work with the clients is exactly what you say. We custom the information of how our customers are and the style of life that they have also. So it has been a pleasure working with you.
Likewise.
And finally, one important question for the season. What is your favorite Christmas food?
My favorite Christmas food. That's funny. So favorite Christmas food is this is actually funny. I hope I wasn't expecting this. I have a secret confession that at Christmas time, my wife doesn't understand me for this reason, but I really enjoy the orange cinnamon rolls that Pillsbury makes. I know they're kind of cheap. They come in that can in the back of the grocery store, but that's like my favorite. It's like it
brings you memories.
Yeah, it's really sentimental. So it's like we always have we have a great meal Christmas Day and everything else, but like that breakfast morning is just that Pillsbury can with the orange cinnamon rolls. That's it for me. That's my favorite Christmas food.
Well, your wife should be happy because she has it easy.
Yeah, she has it very easy. It's like it takes 5 minutes and it's done. So yeah, that's actually funny.
That is a nice. I will say to your wife, don't complain.
Yeah. There's not a lot of work to be done. I'm easy going.
So thank you for the time. I will love, of course, to interview you again, because I think that all this is valuable information. And thank you to everyone for being with us in this time. And any question, of course, you can contact Derek. You can contact me. I will put the information at the end of the video of Derek, and my information is going to be on the description. Have a wonderful holiday time.
Oh yeah, wonderful holiday and Happy New Year if we don't see from you sooner.
And if you are listening or watching this in June, just connect with the Christmas spirit.
I was going to say, there's no more Christmas spirit, but we'll give you updated information. That'd be perfect. Thanks so much.